Fine. So, well, before I start with today's session, let me just introduce myself. I am the instructor of this course, Financial Modeling. Given my experience, it's more than 12 years into various companies such as McKinsey and Company, Ernst and Young, and I started with a company called American Express. Right now, for the last 3 years, I run my own portfolio management company based out of Gurgaon. Uh, I manage somewhere around $100 million asset under management. Well, I don't like the term asset under management, but yes, I manage this much assets, and that's about me. And where financial modeling comes into play is uh, no one has actually taught me financial modeling, but I learned it over a period of time because of the nature of work. I was always interested in finance, and that's why at an age of 21, I landed up with American Express, and I learned all these things there with respect to personal finance. Moved to McKinsey, and McKinsey was one platform. The valuation team there, corporate finance, which taught me immense, stuff, which I personally feel, I owe it to them, both from a handling corporate or client situations as well as financial modeling, and I'm keenly interested in the financial modeling part. However, I do feel that a lot of people feel that financial modeling is all about Excel. I personally feel that Excel is a tool. Whatever inputs you put in, the kind of output would depend on the kind of input that would go in. So you need to be very sure, just to de-link. Yes, Excel is important. Knowledge of Excel is important. No denying that. But equally important is a theoretical and a practical understanding of how things work in this environment. So what this course really what we'll do today is why financial modeling is important. What is the course objective of financial modeling? What are the benefits you can expect, and who should take this course? And I'll also cover something called beta calculation. So, just a quick check. How many of you have heard about beta before? Well, the reason is no, okay. Since I'll be covering this, I need to know whether I need to start from the basics or I can talk about some advanced stuff. So I need to have a just a understanding of the entire group, whether you have heard about beta before. Any finance student must have gone through beta and cost of equity calculation. Well, if you have not, it's all fine. Doesn't matter. I'm just checking with the group. Okay. So most of the class has not heard about beta, so I'll just touch upon the basics first, and I'll then move into the advanced things. But you should just expect, this is just a demo lecture. So given the time we have allotted for beta calculation is not a lot. Normally in the class it takes around 2 to 3 hours just to understand that. But yes, you'll get a basic understanding of what beta is and how you can practically link it. Okay. So let me just introduce the course and tell you how this course will help you. So, this course I have taught approximately more than 1,000 participants now over the last, I think, 5 or 6 years now. I have taught this subject, on webinars in person in India and outside India. Um, and this is the work I do day in and day out, valuations and all this stuff. Uh, so this topic is very close to my heart, and rather than talking about or teaching any subject where my expertise may not be that great, I picked up a subject, and I've been just doing this for the last a number of years now, just to it helps me become better also as a professional, and also I'm able to transfer the kind of knowledge I feel, had I got that knowledge at a very early age, I would have picked up in the right direction. And I figured out later on that this is the way it is. So this course will be an online live course, and it will help you build an understanding of valuation, a comprehensive understanding of valuation. And at the end of course, you can expect yourself to become like an expert in valuations and equity research and so on. So, what this will help is basically, if you are already a finance student, it will help you deepen the understanding. If you're not a finance student, it will help you build the foundation and then, build your knowledge. However, this comes with a caveat that, the Excel part also, which we'll cover in this, is not at a basic level. So I do expect people to be aware of what Excel is and how does that work. The advanced calculation and scenario analysis and so on and so forth, all the advanced function of Excel, surely we'll cover, but not the basic functions. I'll not teach, this is a worksheet and this is a workbook and so on and so forth. So you need to be just aware that a basic understanding of Excel is required. And then we'll focus on a lot of financial theory. I'm talking of a little bit of accounting and a lot more into the analysis part. How many of you feel that accounting is very important when it comes to financial analysis? All right. Okay. Few people are facing some issue. Vishal, are you able to fix your audio issue? I think you've logged off. Okay. So I hear that a lot of people are saying it's very important, and uh, you know, it's very important. Okay, fair enough. So my point of view on accounting is, as a student of commerce and later on masters and everything, I've learned accounting. But in my day-to-day work, more than accounting, I think challenging the accounting practices of management is more important than knowing what are the accounting standards and so on. So yes, accounting knowledge is important, but more than just the accounting knowledge, I feel you need not be aware of debit and credits. I don't know, to be very honest. This would be a debit, this would be a credit. You need not know that. But if certain action is being taken by management, you should be able to just that bell should ring in your head that this doesn't make any sense or this makes sense. Because as you will learn in financial modeling, more than just the Excel piece, there is a lot of qualitative stuff which needs to be done, and that qualitative stuff comes with experience and with a lot of reading of books. And as you grow as a professional, you'll build a knack of challenging anything. So just to give you an example, company coming up with an IPO of say $100 million, and you looked at last year's revenue and sorry, the net profit number, and it was around 80 million. Let's say I'm just giving you an example. So you that should just trigger a bell in your mind that this doesn't make any sense. This company was already having cash. They are going to public to get more cash, so there is some kind of vested interest by the management, which is not pro of the investors, the shareholders. This has nothing to do with accounting. This has nothing to do with even finance. It is just about common sense. And I feel, investing is all about common sense after a certain stage. I'm not saying it's all about common sense, but yes, it is about a lot to do with common sense. So building that common sense will be part of this course. Because what I have felt, my investing experience says that building that common sense and challenging management practices and everything is even more critical than just coming up with a number of DCF. This is a DCF value. So, from that perspective, building that practical knowledge of challenging management or understanding management decisions is very important. Uh, so, you'll understand valuations and its practical application as well. And as I said, building that understanding of practices and which management follow and challenging them is very, very critical part. For whom this course is relevant: commerce graduates, MBA graduates, CFOs, risk managers, chartered accountants, fresh CFAs if they're not into field of equity research, fund managers, private equity fund managers, general managers, and so on. So, in my, as per my experience, I have trained, journalists working in a media house to CFOs of companies, as well as private equity analyst of various sovereign funds. So, the kind of people who would extract value from this course is anyone who is into the business of finance and valuation, and even senior management, because they are expected to know a lot more about these things. As they grow up, it's expected out of them that they are aware of a lot of things. All right. Any questions so far? Can I proceed? Okay. So the course content will be this. So as I said, it covers advanced Excel features and techniques. It will not cover basic Excel. I think to get hold of that basic Excel, you can find a number of videos on YouTube. You can go through them, or it's a very simple stuff. So we'll not cover basics of Excel, but we'll definitely cover advanced Excel. When I talk about advanced Excel, it will include pivots to look up references, goal seek, scenario analysis, lot to do with if function, and even running macros. So we will not cover writing macros because I myself am not an expert in language. I think C++ or whatever that language is, but I know how to record macros. I know how to embed macros, and a lot of people get fascinated with the macro application and everything, but just to let you know that logic is more important than these functions. So yes, you will build an understanding of these functions, but building logic around them is even more important. I would put it like that. So we'll cover that in advanced Excel. Then we'll cover financial statement and analysis. So this is, yes, it is to do with accounting, but as I said, it's not financial accounting. It's financial statement analysis. So how to read annual report, what kind of stuff to look into, all that is covered under this financial statement analysis. Then we'll cover cost of capital. What is the cost of capital for a company? We'll discuss about valuation models, industry analysis, company analysis here, and then we'll cover the DCF modeling. This will take a lot of time to cover. We'll also discuss upon how the private companies are valued, and then we'll discuss about the mergers and acquisitions. Um, so, quick question. Those who are aware of Indian startups and everything, and, it will also help you build an understanding of under. You will be able to challenge even the media houses what they write, because I strongly feel these money controls and CNBCs and all, they don't have any understanding of finance, but still they percolate message that they are you know the best resource, which is completely incorrect. They are just journalists. In fact, I have trained a couple of journalists, and I was surprised to see that they were talking about few stocks the next day. And just before that, they were discussing some basic stuff with me. So I was really surprised and shocked to see that. So yes, after this course, what we'll be able to build is basically challenge any issue you face, whether in print media or in television or these shows they conduct, and you will make some sound decisions with respect to investments. And investing is a profession on its own, and it comes with a lot of practice. A lot of reading is required. Just a 20-25 hour course may not be sufficient to make you perfect in valuation, because even after spending 12 years in this space, I strongly feel that each and every day I have to learn a lot of stuff, and that's the exciting part about the space. You have to enrich yourself with knowledge, enrich yourself with a lot of new stuff which is happening, and link the traditional stuff with it. So before I proceed with the beta calculation, any question with from you guys? So I'll just try and answer the questions I'm getting here. So Kishore, you're asking me which version of Excel is used in this course. It's 2010, if I'm not wrong. I'm using Mac, so I don't know which version they are using, but I think it's 2010 only, which is being used. But I'm pretty sure the kind of Excel models you'll be getting, they will be 2010 only. So Yogesh, you are asking me, my purpose is to pick stocks as an individual investor. I think it should help. So yes, it will help you a lot. It will help you make, build a good foundation. And after that, as I said, investing is a profession on its own. So it will require a lot of practice. So it will not come on day one. Probably it will take few years, and it can become so lucrative as a business that you can sit at home and earn millions. I'm not talking about trading here. I'm actually talking about investing. I'm talking about Buffett philosophy. I'm talking of Benjamin Graham philosophy. I'm not at all talking about trading philosophy here, but that requires a lot of practice, lot of hard work, and a lot of reading. So yes, it will give you a good foundation, but it will require a lot of further work as well. Mukund, you're asking me, does it also cover predictive analytics on stock prices? No, that is a part of technical analysis. We will not cover that. I don't believe in that philosophy. Okay, fair enough. Fine. So before I proceed, let me just show you, few books or a few areas I feel, these were instrumental in changing my thought process. When I was 21, I started trading. Mukund, you were asking me that. By investing 50,000 rupees, I earned like 15 or 20,000 rupees in 15 days, and I was really excited. But I also felt that, this is not the right way, because that was just a fluke, that was just a chance. When you are investing, you have to be like very sure that, you have done your groundwork and there is no way you can lose money. Eventually, you may actually land up losing money on few areas, basis your assumptions not coming through, but those will be less than 20% probability. But if you're investing into, how the demand supply of stocks is working, well, you can make money. But at the end, it's like dealer's house, and it's like going in a casino. Dealer always wins. Stock market will always win. So I don't believe in that philosophy, but I started with that thought process of making money very quickly. And I'm talking of 2003, 2004. 15, 20,000 rupee for a student was a big amount. But yes, I reflected back and I felt, this is something I need to get deep understanding, and that's why I completed my CFA. That helped me understand a lot of stuff in detail. So this is my best book, Intelligent Investors by Benjamin Graham. It was written like almost 60, 70 years back, and it is completely relevant. Benjamin Graham is the father of value investing, and a lot of my attitude towards investing is also driven by this book or style of book. Just to let you know that this is actually the favorite or the first book even Warren Buffett read when he was 19, and this built interest into investing. Just for your understanding that, in case you are interested, go for this book. It's an amazing book. The second book is again the security analysis, how to value a stock, again by Benjamin Graham. Excellent book, but a lot has changed over years, and but it's still worth reading and building up your knowledge. And the last book I recommend is Valuation. So this is published by McKinsey and Company. It's written by Tim Kohler. It's recommended as a valuation book in Harvard Business School. And Tim Kohler was my partner in McKinsey. So whatever I've learned in valuation is actually from Tim Kohler, the master himself. Um, and this book is closely linked with Intelligent Investor and Security Analysis by Benjamin Graham. So this book is on value investing. It's not about trading. So yeah, with that, I'll start the content part of beta calculation. One question I'm getting from Charan is what's the duration of this course? So it's spread over 7 weeks. So weekends are covered. There are, I think, 14 sessions, 2 hour each, and at the end there is a module also that you need to cover, the case study which you need to cover, and the course will be on, we'll be covering one uh, company only, how to build the financial statement, how to do the analytics around this, that DCF modeling and everything, so historical analysis, everything on one particular company, which is a live company. So lot I will go back on the websites and show you, from where to get the information and this and that. So that's the way I normally take sessions, because I know that once the session is over and you're on your own and you're doing stuff. So if theoretically I may say, okay, you need to regress 60 data points to the market index and you will get beta. Well, that doesn't really solve the purpose. You need to know from where you can get those 60 data points. So all that practical perspective will cover in this. Any question? Course fee, I think you can just check on Edureka. It's around 15,000 and they are giving some early bird discounts and all. So you can just check that. But it's priced at 15,000 with some discount if you enroll before a particular due date. Do you have a practical coverage on Basel 239 implementation? No. That's very specific on banking. Not in this course, we are covering banking valuation. Banking valuation works very differently. Well, philosophy remains the same related to banking valuation, but how to do it is different. You use dividends instead of free cash flow, and so on and so forth. And it's a tricky industry to value. Any other question, please? Any other question? Ajay, I think you were not there when I covered this. So this course is relevant for from people who are into practice, like say private equity analyst, to freshers from MBA colleges, even commerce graduates, IT professionals who want to build understanding into finance. So it's relevant for anyone who wants to get into the field of valuations and investing. It's not suitable for a person who is looking for trading related strategies. We will not cover trading related strategies. Ajay, you are into retail banking operations, so depending upon what kind of work you actually have, I would not have an understanding of that, but what is relevant for you would be on the Excel valuation side, the modeling side. So, modeling will help you in your work. But if you're not into equity analysis and M&A kind of scenarios, and if you don't want to build an understanding on that, then probably it will not make a lot of sense. But because just to learn Excel, you don't want to enroll into such a long course. Yes, it will cover profitability models for forecasting projects. Yes, it will. Mukund, that's for you. So there is a lot of demand depending upon the question is what is the industry need on financial modeler and how much demand is there. Um, well, just on its own, I don't think so. People would just hire financial modelers. Usually, it is linked with what kind of skill you bring on table. So let's say if you are into equity analysis or bond analysis, and if you are very good, it's expected out of you that you have to be good with the modeling part. So it's not something that people are looking for a particular modeling thing, because as I said, it all depends on the input that goes into the model, and then the output is linked with that. So input understanding is something you need to build, and that is your skill. So it's not something just by the Excel work you can learn that skill. Excel, any BPO guys are also doing that, right? But you need to build that skill of equity analysis and valuations and M&A, and how the management is thinking and so on. And for that there is a huge demand. I'll just move on, and in the meantime, if you have any question, just keep on writing that. So, what is beta? So, anyone who is from finance or has done this would know about beta, but let me just simplify this. In financial world, beta is an approximate measure of risk a company takes. I'll not get into what kind of overall risks are there because, as I said, practically in the program we cover it for good 3 hours or so, 2 to 3 hours. But here we are just covering it in 20 minutes or something. So I'll just broadly talk about this. And there is something called cost of equity. So as we build our understanding of how the valuations work, one of the critical inputs is at what rate a cost company is taking money from its shareholders or bondholders. So understanding that perspective from an equity point of view, beta calculation is important. I'll not go beyond this because then it will be a very, very lengthy conversation, because we gradually, in the program, we gradually build onto beta. We don't start with beta. But my perspective was, let me just, because this requires some bit of practical application. So what I would expect from you is not to build an understanding of what beta is and the stuff like that, but how to link the calculation of beta with practically what happens. So beta is basically, as it is mentioned, a measure of how much a company's stock moves with respect to the market. All right. And beta is the result of comparing market return with how your company stock has moved. Just to give you an example, when we say that Apple stock is very safe, or maybe not, I'm just making it up. How would you know that Apple stock is actually safe or not? The way you will do that is, you will learn about how the price has moved over a period of time, and you compare it with how the market has moved over time. So there is a measure called volatility in the market. So that volatility, let's say today the price of Apple was 113, tomorrow it is 112, the next day it's 110, then it moves to 114, and so on and so forth. And similarly, there is a movement in the market going on. So how do you compare, whether Apple stock is riskier than the market or not? So this is what beta does. It tells you whether your Apple stock is riskier than the market or not. As simple as that. And the way you do it is basically, you take 60 data points, monthly 60 data points. Let's say if you're valuing Apple stock today, you will take it for last 5 years, monthly data points, and you will compare it with how the market has moved over the same time frame, and you will get a measure. That measure is basically a reflection of how riskier your stock is. So that is a measure of beta. So you get it by regressing it. So we'll get into all that discussion in the course, what regression and how those statistical things work. But yes, you regress uh, Apple stock with uh, the market to understand what is the beta measure of one. If let's say that measure comes to one, basically it means that Apple stock has moved just like stock stock market. So there is is beta neutral. If it is higher than the stock market, it will be more than one, and less than the market, it will be less riskier than the market. So in a simple way. And let me just tell you practically, how to calculate this. So you must have heard about Yahoo Finance. So here you go. It gives you the numbers from 1980. What we need is basically monthly data for the last 5 years. So from 2010, we need it. Here you go. So this is the measure. The close price is basically the data points. Let's say, we need to just copy this. If there is Excel, probably we can use that. Yes, there is. And we also need to have the market, let's say S&P 500. Again, we need to get monthly data point 60. All right, so we have the numbers here. I'm opening a new Excel. Let's write S&P, and we need to have Apple. I don't like grids. Okay, let me just see how many data points we have here. So we have 61, which is fine, because one we have to take. I'll just show you why we need 61 data points here. So this number we need to just index it. So I would say this is these are the prices, and we need to just get an index, because regressing this to this will not make sense. We need to just start with a common factor, and that common factor, let's say we start with 100. It's just that how any market would work, BSC or New York Stock Exchange. They started with a certain value, and that value is usually 100, and from there they grow. So we need to just During the class, we get into all this discussion, and there is a lot of practice around this. Due to paucity of time, we'll not do the practice here, but I'm just showing you how the calculation works. And then we drag it till the end. All the shortcuts and everything we'll do cover in the class. All right. So beta is regressing, which is regression formula is slope. I'll cover regression and everything in the class, but what is regression? It's a long conversation. What is regression and how does that work? All right, I see the problem here. So this, although this number is showing me as negative, but I'll tell you what's the issue, and these are the things you should be aware of when you're creating a model. So you see that our numbers actually started from 100 and so on and so forth, and then I see that there was some kind of split. Most likely there was a split of the shares in June 2014, and probably this broke down by 1 by 6 or 1 by 7, and that's why these numbers reduce. So this number of beta may not give the right reflection. So let me just change the period of this just to get a broad understanding of what this should be. All right, and we have 45 here. So now you see this changes to 0.26. It looks like Apple stock variation with respect to market has been very, very low. Well, this calls for a lot of further investigation, but yes, this is the measure. I doubt this would be the beta measure. It's way too low. I was expecting somewhere around zero point 0.6, 0.65. So we need to investigate further why this has happened. And moreover, we need to get hold of something called total returns to shareholder, which includes the dividend part as well. This just includes price movement. Dividend is not included. See, we might want to adjust the dividend part as well, or get hold of platforms like Reuters and Bloomberg, where you can just simply download the information. That requires a decent level of expense, and usually big companies can afford access to Bloomberg and all. But from an approximation point of view, this really helps. Now I tell you what practically I do when I have to calculate something. So well, before that, any question you guys have? Okay, there are a few questions which are pouring in. So Nitin asks, what is the difference between CFA and this course? Well, this is just a online course where you pay the fees and you take lectures and you apply your knowledge in your work. CFA requires you to clear three very, very aggressive levels. You need to clear level 1 to 3, and then you become CFA charter holder. So these are two not at all comparable things. It's not apple to apple comparison. Uh, that's a certification. This is an online course. So there's a big difference. Are these points available? Yogesh, you're asking, are these points available? Yes, I took it from Yahoo in front of you. So, yes, I took it from public sources only. Well, why it goes up and down, we'll cover that in the course. Well, it has nothing to do with that you have to track it on a daily basis. But yes, as a investor, what you really want to see is, if you're tracking a particular stock, you need to just see that if the market really misprices that, if the market, if the stock price crashes, let's say, you need to be sure that that's a good entry point. So you're not just valuing from exit point of view, but you're also valuing a stock from entry point of view. So it helps you get a perspective on both the things. So the first session, you guys, starts in November itself. Well, there is no way any analyst of the world, even the best of the best, can predict any share price. So people who think that they are predicting market, they are actually making fool of you. I'll be as upfront as this. They're just making fool of you, and you need to, what this helps in understanding, what are the fundamentals that attaches to a company that would impact a share price. And measures like beta and measures like cost, and what is the management doing, what is the economic mode of this company, so on and so forth. All these factors help you understand where the direction of that going. So during the course, I'll cover both the defensive and aggressive investor strategy. As a defensive investor, what you should be doing; as an aggressive investor, what you should be doing. So when it comes to aggressive investor, it basically means active management, and uh, defensive investor basically means when you have to rely on experts, but when let's say you're working with an advisor, but you're still smart enough to understand what the advisor is telling you. He's not just trying to fool you around. So all both the strategies I'll cover during the course. But your question on, can you predict prices? No one in the world can. Just think about it. If you can predict any share price, what it will be after 1 hour, you can be a billionaire now. So that never happens. Beta is, your question is beta a static measure? Yes and no. The way, I discussed about beta, it's not a static, it's dynamic. But there is a concept of levered and unlevered beta, which we cover in the course itself. That really talks about what you can do in order to arrive at that beta. And beta is basically, it should be really reflection of the industry and not a specific company. Let's say a particular industry, let's say IT companies will behave in a certain way, and usually that will not be very different from their peers, right? So that is why it becomes a industry measure than a company measure. With all the capital structure and everything taken into account, we'll discuss in lot more detail in the course, why I'm saying that. But yes, at that level, it becomes a static measure and not a dynamic measure. And that's the static measure I use for my calculations. So, Gaurav, you're asking about, beta link with the S&P. Well, the way you're asking is, you need to back it up with data points. So this is the data point I've taken from Yahoo Finance. You can even use Google. The only thing that would impact this measure, as I said, is something called dividend. If they have declared dividend, which Apple does declare dividend, then this beta measure needs to be corrected, because your returns would increase. So it's not just the price movement, your returns increases, and returns increases, your beta is also impacted by that. So in general theory, beta of 1, if had this number been 1, then it would have been equal to the risk of the market. If it is less, it's lower risk. If it is higher than 1, it's more risk. But practically, let me tell you how it works. Beta measure, you can take it from various websites. Say, this is the Damodran website. You have industry betas for all the industries. Let's say information technology. I'll just quickly wrap it up. Technology information services, so it's coming out to be more than, so as a industry measure it is more. So this is the measure I take, or else you need to just refine the numbers by even looking into the price, the peer set and everything. So in the course we'll create a peer set, and then we'll create the but practically you use this for the calculation perspective, but you also consider the margin of safety. So risk from a financial perspective is this, but the margin of safety I say is, when you come up with a result that, let's say Apple price to be around $50, right? That's your intrinsic value. If it is available at a 30-40% discount, then only you'll buy it, otherwise you'll not. So we'll cover all those strategies, when to get in and when to exit, from a aggressive investor's point of view. But yes, this is a. So I didn't get the question. Generic one. What is the merit and demerit of reinvesting equity on stocks? Can you just elaborate that? I didn't get that. So there will be ongoing courses, Yogesh. So you can check with edureka when they plan to schedule the next one. But yes, there will be ongoing courses. Yes, so for a very short while, 60 weekly data points, it can be impacted. 60 is basically what we're looking at is not even 1 year, just little over 1 year, right? So in 1 year is too short a period for assessing risk of a company. In fact, if there is any major change in the stock, you should exclude that, or in the market, you should exclude that period. And 60 monthly data points it is, not weekly. It could be actually more than that also. Predictive modeling, we do as a sensitive, we'll understand the sensitivity analysis. In that, we'll understand, if growth is impacted or cost is impacted, what would be the impact on the price, what is the implied growth, and so on and so forth. So that comes under predictive analysis. Although I still feel that, those are different scenarios you're building, but nothing is, very concrete. You need to challenge that and go back whether, you're saying the company would, instead of growing at 6%, will grow at 10%. So what are the basis for that? You need to back it up with something. But yes, it helps you create various scenarios. So for beta, 60 data points or plus. Yes, we'll be talking about valuations of startups. So in private company valuation, that will be covered. And you'll be surprised to know what these media houses print is all rubbish. So in a way, I'm just trying to say Flipkart is not valued at $50 billion. If it comes even at a $5 billion, I'll be more than surprised. They will never come with an IPO. They're not profitable. Well, you cannot predict future prices. So high beta is an indication that a particular industry behaves more riskier than the market. Will that have any impact on your investment strategy? Probably not. It will have some impact on the cost. I'm not able to understand this question. Not much actual values will be there, but just projections. All right. Well, with startups, the unfortunate part is you can have a lot of assumptions, even with the companies that we'll study, with your companies, even with them, we'll do a lot of valuations and projections. It's just that, with startups, it doesn't make a lot of sense to do those projections. Yes, you will build aggressive assumptions and it will be valued higher. But, as we'll go through the program, there is something called operating profit, no plat and all. So talking about no plat numbers and all with respect to these startups, I think 99% of the startups, at least in India, would fail to meet that criteria. And I am very, very strong believer that all these startups like Flipkart and Grofers and so on and so forth, they will not exist in the future. Forget about they coming up with an IPO. So we'll talk about all these practical scenarios, why I'm saying this, and why I'm not a big fan of startups. Um, all right. So I think I've covered pretty much everything. So from a beta point of view, it's not that you have covered a decent understanding or covered beta in a detailed form. This was just a teaser in terms of how to link what is publicly available and theoretically combining them together and coming up with a result. But as I said, you need to challenge a lot of numbers and come up with the right it's analysis. It's a lot of analytics involved, a lot of brain involved, and a lot of common sense involved. I would put it like that. It's not a brainy work, but it's a lot of common sense involved. And when we bring those common sense on table, a lot of so-called popular companies would fail to meet that criteria. So I'll talk a lot about Benjamin Graham, the strategy, and what is a defensive strategy, what is an aggressive strategy, how to combine it, how to grow wealth, and so on and so forth, whether it's for individual investing or from job standpoint. From both perspective it will help, whether you're a fresher, whether you're a mature professional, it will help you a lot. Any other question you have, you can shoot, or else we can close the session for today. In case you do not have any questions, you can actually log off now. These are the details, by the way, if you just want to check. Charan, you can actually write to Edureka. They will reach out to me for anything. They are the first layer. And I'll be more than happy to answer anything you have. You can write them an email. Daniel, you said that you missed out on the session. You can check with Edureka. I think they will be sending you the recordings, but just check with them. I think they would most likely send you the recordings. There were a lot of recordings going on at my end also. So I think they'll share that with you. Mukund, you're asking me what kind of models you use to establish required return on and investment and risk. So popularly used as CAPM only, capital asset pricing model, that is aggressively used for India as well as outside India. Um, well, it has its own flaws, but there is no other better model to create to come up with that. So cost of capital is derived on that. However, practically also you have to just see, if a certain company has to go out and borrow money, what is the expected return from a capital point of view. So it's not just from a modeling perspective, but you have to practically apply also the what is the risk-free rate of India. It might be a US bond, sorry, India 10-year bond is trading at 7.9, but I normally take 7.5 because that's the average. So all those kind of things needs to be established. Any other question? So as you will know that modeling will be just a base, and after that it's lot of work with respect to practically how to link things. Well, Excel is more than enough for modeling. You don't need any other thing. Charan, you're asking this question. Because I didn't get your question. Well, Mukund, just answering your question. So that's where your understanding about different analysis would come. For example, I said that this 0.26 doesn't seem to be right. So that basically meant that the number we have arrived at is not the right beta number we can use. So we have two choices. One is to investigate why there is a difference. The other is to actually use a different method. For example, I looked into what Damodran is saying, and Damodran is saying it's around 1.1. So either we can use that, or probably create a peer list, and from peer list we can do an averaging of the industry and see what is that average and compare it with what the company is saying. So practically the way it works is you do a peer analysis, come up with a beta measure, you unlever it, and then you lever it with the company's capital structure. That's practically how it works. So just to avoid that, we can use the Damodran, that beta measure, because nowadays, given the globalization and everything, it's not that beta for India will be very different from what in the US. It will not be different. Well, Mukund, you will always use your judgment. Modeling is a base. That understanding is also very important to play around different scenarios in the current environment. Back in 50 years back, this was missing, but that does not replaces, your content, your knowledge, or your judgment, right? Even in today's time, just to give you an example, Warren Buffett would not spend a lot of time on his Excel, and he would spend more time reading annual reports. So, in the program, one of the major emphases I have is not just the Excel and the modeling part, but how to read those reports, how to challenge those numbers. And you will see that everything is there in the report, it's just that you need to just challenge it. And a few years later, you'll figure out, oh, you made a right decision of not investing or investing in a certain company. So yes, modeling and judgment or knowledge will go hand in hand.